Here's something most parents don't know. Your child can have their very own retirement account, even before they graduate high school. It's called a Roth IRA for kids. And starting one early could give your child a 6-figure or even 7-figure head start on their financial future. And the best part, the earlier you start, the less money it takes to build serious long-term wealth. So let's break down how this works. First things first, to open a Roth IRA for your child, they need earned income. That means money from a real job, whether it's part-time work at a local store, lifeguarding at the community pool, or bagging groceries. It can also mean self-employment income like babysitting, mowing lawns, tutoring, pet sitting, or even running a small business of their own. But here's the key. Allowance or birthday money does not count. Gifts don't count. The income has to be real, and it has to be reported. That means it should show up on a W-2, a 1099, or at the very least be tracked and reported on a tax return. Now, once your child has earned income, you can contribute up to the annual Roth IRA limit, or the amount they earned, whichever is less. For example, if your teenager earned $3,000 at a summer job, you can contribute up to $3,000 into their Roth IRA for that year. And here's something many parents don't realize. You can actually supply the contribution on your child's behalf. So if your teenager made $3,000 from a summer job, but they want to use it for gas, clothes, or saving for college, you can step in and put that $3,000 into their Roth IRA for them, as long as the contribution doesn't exceed their actual earned income for the year. Now, why a Roth? Younger investors often benefit more from a Roth IRA than a traditional IRA because they're usually in a very low tax bracket. They don't need the immediate tax deduction. Instead, with a Roth IRA, their money grows completely tax-free for decades. That long runway of compounding can turn even small contributions into massive wealth over time. Let's put some numbers on this. Say your child makes a one-time contribution of just $3,000 at age 15. At an 8% annual rate of return, by the time they reach age 65, that single $3,000 contribution could grow to nearly $160,000. Imagine that. Now let's stretch this out. If they contributed $3,000 every summer during high school, so just 4 years of contributions, 4 years, for a total of $12,000 invested, by retirement, that can grow into more than $600,000. And if they keep contributing just a few $1,000s each year through college and into early adulthood, the numbers will continue to grow exponentially. That is the power of compounding. Over 40 or 50 years, time is their greatest asset. But it's not just about retirement. Roth IRAs also come with some built-in flexibility. Because it's a Roth contribution, not the earnings, just the contributions can be withdrawn at any time without taxes or penalties. And that means if your child later wants to use some of the money for a down payment on their first home or for qualifying education expenses, the money is accessible. There's even a special rule that allows up to $10,000 of Roth earnings to be withdrawn tax-free if it's used for a first-time home purchase. Now, ideally, you'll leave the money alone and let it compound as long as possible. But knowing those options exist can give parents and kids more comfort about locking the money away in a retirement account at a young age. One of the hardest things for adults is that they often don't start saving till their 30s or 40s. By then, they've already lost 10, 20, sometimes even 30 years of compounding. But if you flip the script and help your child start saving at age 15 or 16, it could be decades ahead of their peers before they even finish college. To put it another way, someone who contributes $3,000 a year between ages 15 and 25 and then never contributes again will often end up with more money at retirement than someone who waits till 35 and contributes $3,000 every single year till they retire. That is how powerful time in the market really is. Of course, There are a few rules and pitfalls to watch out for. The biggest mistake is trying to contribute without real earned income. Babysitting for cash under the table without reporting it does not count. If your child works in your family business, you really need to make sure they're being paid at reasonable wage for the work they're doing. And you need to issue proper tax forms like a W-2 or a 1099. Please keep good records, file a tax return, and make sure everything is legitimate. The last thing you want is to have the IRS question the contributions years down the line. Another common question parents ask is, should I prioritize my child's Roth IRA? Should I focus on my own retirement first? The truth is, your retirement should come first. But if you have the means, helping your child start theirs early is one of the best financial gifts you can give. And remember, this doesn't have to be thousands of dollars at once. Even smaller amounts, $500, $1,000 a year, can make a huge difference when they have 50 years to grow. So let's just recap. To open a Roth IRA for your child, 1, they need earned income. 2, you can contribute up to their annual limit or their income, whichever is less. 3, contributions can come from you as long as the income is documented. 4, the money grows tax-free for decades. 5, starting early can create life-changing wealth by the time they retire. So, if your child is working, don't overlook this opportunity, please. Opening a Roth IRA now is one of the best financial gifts you can give them because time is really on their side. If you found this video helpful, be sure to subscribe to this channel. Every week, we share strategies to help you take control of your retirement, understand investments, and grow your wealth effectively. And if you're ready to take the next step, use the link in the description to schedule a free consultation with our experts. One conversation can set your family on the path to long-term tax-free growth. Thanks so much for watching.